Pavel's question is on continuing allocation for credit spreads or debit spreads in your portfolio. His question directly is, my put credit spreads brought in a significant percentage of profit for my account, and I was hoping to scale those profits accordingly into the continuing trading methodology that's working for him. Once the current market settles right now, it might be a little dicey to be entering new bull put spreads right now. We want to get a little bit more of a signal of where the market wants to be before we start doing the credit spreads, bull or bear in that case. But his question is, assuming that the percentage of the account dedicated to credit spreads remains the same, 10 to 15% of my portfolio to allocate to the credit spread positions, what are the best practices for scaling the credit spreads with this profit? For example, would I add an additional spread? So what does he mean? If I'm already trading, part of my trading plan is to just open 3 or 4 trades on the next cycle that I'm opening new positions. Should I go up to 5, 6, or 7 trades, taking in the profits I've received from the credit spreads? Or keep the same number of trades, those 3 to 4, and increase the position or the contract size? Meaning if I was normally doing 10 contracts, now after a few months I've taken the profit, would I up those to 12 contracts, and then up to 14, and then up to 15 contracts? Or make the spreads wider. So if I'm normally doing a 2.5 point spread, should I go to a 5 or a 7.5 point spread to allocate those funds? All right, now we discussed this initial portion last week on that webinar I had just mentioned in the recent posted content, Stops on the Debit Spreads Portfolio Allocations, that we prefer to use only 10 to 15% of the portfolio to allocate to spreads because of the risk-reward ratio. And personally, it doesn't have to be your approach, but I like to open about 3 to 4 trades each cycle with that allocation. So now if the profits have increased because we've had a successful year, successful 5 months or 6 months, which is best? Increase the number of trades up to 5 or 6, increase the position size and keep the same trading plan of 3 or 4 trades, or make the spreads wider, which would increase the margin requirement, but you'd still be getting a net credit in. Okay, so what would it look like? Let's say that I started out with $10,000 at the beginning of the year, January 4th, 2021, 10 to 15% of my portfolio. Let's say we take 10% of 100,000 portfolio, we allocated it to credit spreads. And then today, of course, after some trades have been closed out, we have an increase of about 52% profit. We're sitting on about 5,200 or so of extra capital that we earn, a 52.3% return on the portfolio. What am I going to do with that money? Well, let's take a look at the pros and cons, adding more trades. My approach, and again, it doesn't have to be your approach, but what I found works best for me, and this is why I teach it this way, but this is why you're all here, because we get different insights to it that can benefit one way or the other. But you've heard me say over the course of several webinars that what I prefer to do is, again, we're going to open 3 to 4 of the top trades that match my default criteria. So I'm going to run the search. And this afternoon, of course, what came up on the search at the close, 4:06 p.m. Eastern Time, is Accenture at a 17.6% return, Roku at 17.6%, Apple at 16.8%, Meta at Facebook at 16.3%, Twilio, and then we get down here to AMT and McDonald's, about a 12%. We get down here to Oracle, 11.7%, Caterpillar, 11.6%, and so forth. Now, when I run this search and I'm going to start selecting my trades, I'm not going to just take the top 3. We're going to use that more information button. I'm going to look at the stock chart, the company information. I'm going to make sure I'm comfortable with what this stock is doing. Is there any news out there that might cause me hesitation to enter a bull put spread or a bear call spread? These are bull puts, for example. And but if I decide not to do Accenture, okay, I move to Roku, and let's say that I enter Roku. And then, okay with Apple, so I go ahead and place that trade. So Roku is number 1. This is number 2. Let's say I don't like Facebook right now. Twilio looked okay, so I did that one. All right, so a 17.6 potential if I get filled at midpoint, a 16.8, and a 14.2. I want to keep my average in this 14 to 15% on my winners. That's what I'm looking to accomplish. That's my personal target goal. Now, if I decided to take some of those profits I've made over the last 6 months, over the last year, and increase my number of trades, well, I might not like AMT, but I go with McDonald's at 12. Maybe Alcoa looks good. I do that one at 12. Don't like Oracle's been really strong after the earnings, but that's an earnings pop. Are they going to be able to keep it up? Maybe. Maybe I'm hesitant. Caterpillar, and then I go with Visa. So the next 3 trades that I enter to increase the number of trades are at about an average of an 11% return. Am I bringing my goal down? Am I still hitting my targets with the lower return spreads by taking on more spreads? Or am I skewing away from my trading plan and lowering my average 14 to 15% down to when I was 6 trades and the other 3 having an average of 11.5, let's say? Am I taking the whole thing down to the 12 to 13 range or the 13 to 14 range? That's what you have to ask yourself with the results that come up, Pavol, when you start looking at the search and evaluating, hey, okay, if I did take 3 of these top 5, but then I took 3 of the bottom 5, would that affect my return and my targets that I'm trying to do for this strategy? Whatever your targets are, I know they're not mine, they're a little different, and that's fine, that's great. But that's the concern that I have about adding more trades in the position. What about the pros and cons of increasing position size? This is what I typically do. Does not have to be what you do. I'm going to keep the same relative targets and allocation, 15% of my total portfolio. So let's say we started out with $10,000. That was 15% of whatever my $80,000 or $8,000. I'm sorry, $80,000 portfolio, whatever it was. Okay, but I allocated that $10,000. So if I'm opening 4 positions, I'm allocating $2,500 to each. Now that we've increased the cash on hand up to $14,300, and that's still 15% of my total portfolio, now it's increased to $3,575 into each, or it's a little bit over 14 contracts. So I'm trading 14 contracts now on 2.5-point spreads, as opposed to 2,500 or 10 contracts on a 2.5-point spread. But if I'm still taking those top 3 or 4, Pavol, that match my criteria, where am I? I'm still in that 14 to 15% return without scaling that down a little bit because the lower return trades by trying to increase it to 6, 7, or 8 trades potentially. Okay? I'm keeping the same general trading plan. I'm just allocating a little bit more, keeping the same target, of course, the same probability from the search, but the same return target on those top 3 or 4 trades that I would enter. So I'm staying within my trading plan. That's what I prefer to do personally. And it's usually about every 6 to 8 months, I think, that I reallocate and reshuffle. I let it build up a little bit more. I don't do it every month. I sort of rebuild it, evaluate it, every 6, maybe 7 months or so. That's just me personally. You could do it every 3 months, every quarter. That's probably a better approach. All right. Now, pros and cons of a wider spread. Now that I have more money, I can do wider spread positions. I don't have to do a 2.5. I could do a 7.5. I could do a 10. I could do a 12.5-point spread. But take a look at this. It is not linear. What I did here is just search for Apple positions expiring in the next 14 days on December 31st with the minimum 85% probability and a minimum 9% return. The trade that would most likely pop up on my list would be the Apple 160 to 157.5. Actually, 3 of them would, but most likely this first one, 160 to 157.5, midpoint net credit on a 2.5-point spread of 36 cents, which is a 16% return. And of course, I'm doing 10 contracts, it'd be $2,500 allocated to this. If I was in now that $14,000, Pavol, range would be allocating about $3,500 to this, so it'd be about 14 contracts. The 5-point spread, 160, same sell option, because we want the 85% probability, I do. And the 10-point spread the 5-point spread, higher net credit, 62 cents, but only a 14% return on the margin requirement. Still probably pretty good. Help me get to my 14 to 15%. That's still a thumbs up. 7.5-point spread, 79 cents, only 11.8% return. We go now to the 7. Okay, now it went to the 157.50. But what you'd see here is if you kept going this way, if it kept going with the 160s, and you did the 160 to the 150, you did a 10-point spread, this return would be around 10%. If you did the 160 to the 147.5 at 12.5, this would probably have dropped down to 9. I think I took the wrong screenshot, and I apologize for that. As you go wider spreads, the net credit increases, but the return does not. The return goes down because it's not linear, where I'm doubling the number of I'm doubling the spread width, Pavol. What am I not doing? I'm not really doubling the net credit. Here I kind of am. No, I'm sorry, here I'm not. It would have to be 72 cents. And I have to go 3 times the spread width. I'm not getting 3 times the net credit. So again, am I getting the returns I want, the target that I had in mind, by widening the spreads out? Most likely I'm not. I would rather stick with the same initial play, the same initial trading plan, that when I start to get profits and I want to start reinvesting those profits from my strategy, with spreads, of course, what I'm going to look to do there is keep the same approach. I'm going to keep it to 3 or 4 spreads each cycle. I'm going to keep the same target return goals, 14 to 15%. I also get to keep a smaller limited number of trades that I have to track. I don't have to track 8 trades now, okay? I just have to stay with 3 or 4 trades that I want to do. It doesn't deviate into a new trading plan or a new management. What do I mean by new management? Using those wider spreads, 10, 15, or 20-point spreads, if I even went that far, but I'd have the lower return where I wouldn't be hitting my targets, again, because that net credit gain is not linear to the multiple gain of the difference in strike prices. But now that they're so wide, I have to consider, what is a good stop to use? Is there other rolling opportunities I should do now that these spreads are so wide? How far is too far to let it go? It's still probably the 50% loss I'd want to close it at, Pavol, of course. But that's so deep now. That's such a big loss, even though I've allocated more to it. I would stay with the same plan, increase the number of contracts with the profits of the top 3 or 4 trades that I'm using. Keeps me in the same mindset. Easier to stay with my trading plan and my management techniques. I don't have to make any adjustments to that. And I don't risk falling off of my target return by adding additional positions that might not have the same target return that I want on the lower end of my search results, or by taking too wide of a spread where it doesn't have that there.